Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. We're covering earnings reports this week, and in this video we have our senior equity analyst Ben Nye discussing Procter Gamble. Thanks for joining us.
Okay, well today we're going to be talking about a variety of earnings reports. Procter Gamble, again, we are long Procter Gamble. I wish I could have said we're not, because it hasn't been a source of pride or success or financial value over the last quarter, but it is what it is. When we talk about Procter Gamble, you got to put in context where we are. So Procter Gamble is in a space that's getting constrained on costs. Their costs are going up, their materials costs are going up, their wage costs are going up, their freight costs are going up. Remember, like, no one can find truckers anymore. No one can find truckers. Grocery stores are trying to become leaner. So what happens when grocery stores try to become leaner? Well, they reduce inventory. So you have some inventory channel reductions there. So those costs, the freight costs go up as well. And at the same time, the wage increases mean that people aren't really able to afford significant price increases in Procter's products. So you have this steady and even declining trend in terms of how much Procter's getting paid. And then you have this rising trend on how much it costs to actually get goods to consumers, package them, produce them, ship them, sell them. So through that all, Procter's been trying to dramatically reduce costs, get these productivity improvements, but investors aren't buying it. And one investor in particular, Nelson Peltz, really wanted to make some change. He said, this management team's not up to snuff. You know, we got to get rid of them. He tried a proxy fight, didn't work. Procter, obviously, their management team were running scared. They didn't want to get squeezed out of the company because they're getting paid. And as a result, you see them have a little bit higher expectations than they probably should have, looking for price increases to happen sooner than they probably could have. And as a result, you have a stock that has kind of lost its way. I think the company's actually doing some of the right things. They're actually getting some growth. They're getting some volume growth, importantly. I think their biggest issues are on the grooming side and on the baby side. So grooming, think Gillette. Especially on the men's grooming. They had a lot of price decreases last year, but those should start to lap over the next few quarters. So I actually think that the grooming business is somewhat contained. On the baby side, though, they just didn't have any answers in the conference call. I was astonished. These guys come out and actually call out baby and the diaper business as an area where they're actually really struggling, and then they don't have any answers for it. They say, well, China's actually turned the corner. Okay, great. China's turned the corner. What about the U.S.? Well, in the U.S., pants are doing well. These pant diapers. I'm like, first of all, I don't have kids, so full disclosure there. But really? Like, you're keying your future growth on pant diapers. Give me a break. I mean, it's almost comical. And they especially when they called this out and didn't elaborate on it. And they said, well, we'll get it turned. Yeah. Why? What confidence do we have? What confidence do analysts have that you will get it turned? And some analysts were just throwing the baby out with the bathwater here. The Goldman analyst says, your price mix is eroding. None of that disruption looks like it's poised to abate anytime soon. Why should we expect price to improve going forward? Shouldn't we assume this is a new reality and look to address the cost structure more aggressively? Another analyst said, seems there's always something going wrong with P&G. What is plan B? What is the ripcord option? Shed your headcount by 80%, not 25%? Are you just going to have to accept, and we're going to have to accept, that you're over-earning? And the management team said, you know, this is not business as usual at Procter & Gamble. This is not business as usual. We're going to go for big growth. We're going to really put the pedal to the metal, and we're going to change things. We're really going to improve. Analysts aren't buying it. They said, we've heard this same line for the last year. I have a printout of Merrill Lynch's downgrade of of Procter Gamble this morning to neutral from buy. And basically, it's low visibility on turn. That's what the title of the note is called. And that's the sense that we get. And the problem for Procter & Gamble is now they've totally lost the street. And when you lose the street, you don't get them back in a quarter. You might have a decent quarter. You might get a little bit of price increase. Analysts aren't going to move for at least 2 or 3 quarters after that. So what you have for Procter & Gamble is almost a dead story. Now, if you're a long-term investor, you like the brands, you like the Vicks, VICKS, you like Gillette, you like the Pampers, then, maybe you take a shot on Procter. But as far as the trends actually reversing and analysts appreciating it and giving you those upgrade boosts, I think that's going to take quite some time. You're seeing margin compression. You're seeing pricing that is only expected to turn sometime next year. Now, the fiscal year does go from July 2018 to June 2019, but that's a huge window they have to improve pricing for 1 quarter. I mean, this may not happen until the pricing may not turn for more than a year from now. And a lot of analysts and a lot of investors are not going to be content just to hold the stock and wait for that turn to continue, because they don't want to wait that long. When the market's going up, they don't want to wait in a dead stock. And that's what they perceive Procter & Gamble to be right now. You get a 3.5% dividend while you wait. It's right for some investors, not right for some other investors. So Procter & Gamble is probably one of the weaker reports that we've discussed.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.